Welcome to the program. My name is Marty Shenkman, and I'm joined by Nathan Gallagher. I will let him tell you who his wonderful company is. And Nathan is an appraiser, and this is part of an ongoing series on collaboration where I've been speaking with financial advisors, insurance consultants, now an appraiser, and soon an accountant to try to just talk about what we all know is critical to getting a great result for our clients, which is collaboration. And we're gonna get some insights from Nathan on how we as non-appraisers can do a better job working with the appraiser. So Nathan, tell us about Stout real quick, and then let's talk about appraisals and collaboration and some of the common issues you see.
Absolutely. Thanks, Marty. So I'm a managing director within Stout's Evaluation Advisory Group. Stout is a national financial advisory firm with valuation, investment banking, dispute consulting, and accounting reporting advisory and transaction advisory groups with about 1,400 employees, over 20 offices nationwide. Yeah, looking forward to having the discussion with you.
So let's talk about collaboration. When we were kind of chatting ahead of time to prepare, one of the things that you pointed out, which is really true, even for the biggest of clients, is that the kind of transactions that we as estate planners bring you in as an appraiser, these are usually pretty large transactions. They're large for the client, and they're also very infrequent. So you're creating a situation where the process is almost probably almost always an imposition on the client. And if it's an active business or real estate development firm, for example, or a manufacturing company, the clients are busy trying to run their business, and we're imposing all this stuff on them. Why don't you talk a little bit about that and how we all, as an advisory team, can maybe smooth the process for the clients?
Absolutely, and the goal really is to make the process as smooth as possible for the client. The appraiser, of course, has a responsibility to do the necessary diligence, gather the relevant information, do the analysis and market research to come up with a supportable conclusion of value, and then document that conclusion in a narrative report that will withstand scrutiny of the IRS or whomever external party might be reviewing the appraisal. But to get to that point, there is a process that can require the client's time. It can require, if the client is the owner of a closely held business, it can require the time of the management team of the company and other advisors of the client. So what I found is that it's important for the appraiser and the advisors, in many cases the client, to just have a conversation at the outset to understand what the goal is for the process, what the client is looking to transfer, when they're looking to transfer it. The appraiser can communicate a timeline. Expectations can be set in terms of the management team providing information, a diligence call being scheduled, and also for the appraiser just to flag if there's any questions or clarifications that come up, to flag that very quickly. So if it takes time to address, it can be done in parallel with the appraiser's work. The other item is what I found is it's important for the appraiser to emphasize that they're going to request information, but oftentimes it's more of a wish list. So there can be items that are not readily available. That's a conversation, right? There can be kind of a modification to what is requested, or there can be more of a conversation to address ultimately what the appraiser needs. So that way the client doesn't feel overwhelmed right at the outset of the process that there's just this request that may or may not be, ideally would be in line with what the company is that's being valued and accustomed to that, but that they don't feel that it's an imposition or they're overwhelmed with the process, that they can have a conversation or express any concerns right from the outset.
I'm smiling because I think every client thinks everything we do like this is an imposition, but maybe less of an imposition. Let me change gears completely. And I've had some very interesting conversation over the years with people at Stout, and I'm not sure, and you can comment if this happens enough. Maybe it should happen more. But when I've had transactions that seem interesting, kind of one-off transactions, different from, here's a warehouse development firm. Tell me what it's worth. Give me a discount. When I've had, somewhat unusual transactions, they've presented, I feel, some very interesting valuation opportunities. And by talking with the appraiser before, way at the beginning of the transaction, before almost anything was done, before we even started drafting any documents, because maybe we had a proposed plan, we've made some very interesting tweaks and even significant modifications to plans based on our discussions with the appraiser. And I'm going to use three actual examples, obviously with no details, and then maybe you can comment on how we can get more communications and the benefits of that between the overall planning team and the appraiser really early on in the process. So one, I had a client that it was a wholesale company, and they had made transfers based on some formula that they had. And I was concerned about those prior transfers uh, facing the potential of an imputed gift. And by speaking, and I was very concerned about it because it just seemed like the number was quite low. And I spoke to someone on your team. I guess we shouldn't name his name. It doesn't matter. But based on his knowledge of the industry, he was telling me that the a formula approach they used may be aggressive, but it was probably supportable. And it kind of changed the direction of where we were going to try to shore up all the past transactions. Another one, which we just talked about and you're familiar with, and I won't tell everybody how big the overall discount was because then they're going to all ask you for discounts of that magnitude. But we had a very unusual business, and it dawned on me early on, and I did this even before I engaged you, that the type of assets that were held were highly concentrated in terms of the industry they were in, and even more concentrated, unlike anything I'd ever seen in terms of geographic distribution. And the place that the idea came up with when I was at the family's office, the patriarch was proudly showing off a map that showed all their locations all over the country, and like 98% of them were in two counties. And I went and did some calculations of how much, because you can find anything online now. And I don't know if it's accurate, but it was enough to raise the idea how much of that particular type of asset was sold each year in those counties compared to the square footage that this company had. And it was something like 20 plus years to liquidate based on what has been sold in a typical year. And you guys went to town with it. And in the end, you had, in addition to marketability and control discounts, an absorption discount. And I think the overall discount rate, I won't say it because everyone will ask you to get that for them, but it was really quite unique, and it was an incredible transaction because of that. The discount made the transaction.
Right. And I think, it was a very interesting project. And I think when we talk about discounts, the question also can be raised, discount from what, right? When you look at a typical asset holding company and there's an ability for the controlling interest owner to sell the asset and you're transferring a minority interest and there's no intention of selling the asset. So control and marketability discounts are applied to. This is a different situation because there was really no feasible or economic way to sell the underlying portfolio, like in one fell swoop. So the discount was in a way endemic to the entity and endemic to the portfolio. And so the valuation approach really looked at, and if I recall, we looked at a market absorption discount in a couple of different approaches, right? One was, if you just sold a portfolio in one transaction, what type of discount would a acquirer of the portfolio demand, right? Second approach is more of a what you call like a dribble out approach, where you're not trying to sell the whole portfolio, but you're trying to sell one property at a time based on what the market is able to absorb. And that takes a significant period of time to wrap up if you're going to take that approach. What we found is if you were to sell the entire portfolio, there would be barely enough value to cover all of the debt with the portfolio. But if you were to sell the properties over time, there is debt, there is financing cost, but of course there's yield, there's income generated by the properties, and the proceeds can be used to pay down the debt over time. that was a process which would have resulted in a much higher equity value. So that was where we gave primary approach. We also gave a primary approach to an FFO approach where we're looking at really, you assume that there's no sale. You just assume you're buying a minority interest and you're buying it based on the cash flows. What kind of multiple might you get off of funds from operations? In other words, net operating income less interest expense. That was another indication of value. Those two indications of value that we gave primary weight to are really only relevant in the context of a long holding period for an investment in the company, not any sort of pending liquidation. And that was the intent of the entity for a long-term multi-generational hold. And so consistent with those approaches, we also applied a marketability discount because in order to realize that value, you would need to have a longer-term hold. And so that would be internally consistent with, again, a marketability discount on a closely held investment in that company. So that's something we're seeing more and more is when you have these multi-generational family companies where there's an expected long-term holding period, we look to really how is a company expected to operate? What kind of cash flow is the company, in fact, expected to generate? Because that's ultimately what the recipient of the interest is going to be receiving. So more and more, we're looking at those types of approaches.
And what you came up with working with us, we changed several aspects of the structure of the transaction in light of it. The third one I'll say quickly, and I was very disappointed it didn't come through. Maybe I'll get surprised and it will, but it was really interesting. I had a very interesting, detailed conversation with someone at your firm about calculating the coupon on a preferred partnership freeze. And again, the facts and circumstances were so unique that it was like hard to imagine this ever arising anywhere else in terms of the equity that the junior generation already owned, the nature, the very, very specific nature and creditworthiness of the um, properties that were involved and the tenants in those properties. So I guess the bigger point, and maybe you can, if you want to make any general comments, is I think a lot of times the estate planning team almost hands off to the appraiser, here's the interest, please give us a number. But I think that if you work collaboratively with the appraisal firm, and even if it's complicated for us as non-appraisers, to forgive the expression, look under the hood, sometimes some very interesting things come out that could really leverage or enhance the quality of planning we're doing.
Right. And I think, preferred stock freezes is definitely an opportunity for that type of collaboration. So generally, there are different types of structures with a preferred stock freeze, but the most common structure is you have a certain asset or a business that is contributed into a preferred partnership. There's also cash that's contributed. And then there's a recapitalization where a certain number of preferred units are issued, generally disproportionately to the senior generation. Common units are issued generally disproportionately to the junior generation. But how that recapitalization should take place can be iterative, right? Because if there are more preferred units that are issued, so a higher percentage of the overall capitalization of this newly formed entity is comprised of preferred units, there's going to be less coverage. So those preferred units are going to be riskier. There's less coverage both from an income standpoint as well as from a loan to value standpoint. Because they're going to be riskier, the required fair market coupon rate that needs to be established upon
Goes up.
recapitalization is going to go up. And so at a certain point, the structure can become simply not feasible because the required coupon rate becomes higher than the income that's really generated. So there would need to be a recalibration to reduce the portion of the capitalization comprised of preferred units to pull that down to a more reasonable rate. There can also be, a change in the amount of cash that is being contributed, as part of the original capitalization of the preferred entity. So ultimately, that calibration is going to be driven by the goals of the client. How much income, first of all, is the senior generation expecting to receive, but also how efficient, how much cash needs to be contributed to make the process work. So that becomes a conversation, right? And it's more more of a holistic goal, in terms of what the client's needs are for that structure.
Let's change gears and talk about another topic that we had mentioned, which is the definition of value. And I just had a very interesting transaction I was involved in that I think had more valuation issues than any I've seen before. Maybe you can comment on it. And I think this is also sort of an illustration of why it's very important for the estate planning team to consult upfront and early in the process with the appraisers, because which values are you using and what are the implications? So the transaction was a tax-free merger, 368 B tax-free merger, and my understanding from the appraisal work done was that the values are kind of calculated under 368, but there's no express definition of values because there were, I guess I'm going to use the term loosely, related parties for the different companies. There was some 482 analysis as to possible adjustments in transfer pricing that were integrated into the value. But separately from that, because of the size of the transaction, there was a question of whether there was a Hart-Scott-Rodino filing. And for those not familiar with Hart-Scott-Rodino, it's a filing, pre-merger filing notice to the FTC that has to be done before the transaction is consummated. If the value of, and I'm going to very much simplify, the company involved is 126 million approximate or greater, and that number inflation adjusts each year. I'm still not fully clear on how Hart-Scott-Rodino determines value, but it seems to use fair market value language, but I'm not sure that necessarily tracks what is done for a reorg or for gift tax purposes. And because there were family members and a younger generation involved, I was concerned about gift tax. So I guess that's kind of a convoluted lead in. Talk about some of the different values. You can comment on any or none of what I just mentioned, but I think it's important for the team to consult with the appraiser early on, because there may be other values that are involved in the plan that are either being overlooked, like a Hart-Scott-Rodino filing I've seen overlooked by a number of people, or people may not realize that there could be a different nuance to each appraisal.
Right. And what we found, the key differences that we see in a gift tax context is there's a transfer of a very specific asset, right, or an interest in an entity. So we need to focus in on what that interest is that was transferred. If you have, really an exchange ratio that's developed for a merger between two companies, generally the value you're looking at is considering the value, the values of the companies in their entire. So if what was transferred is a minority interest in, the combined company, then that interest, ultimately might warrant discounts. You might also have a context where you have a public company where there is a exchange ratio developed, but there are lockup restrictions on the shares. Those lockup restrictions and any marketability discounts associated with that would need to be considered in a gift tax context, and also a charitable donation, kind of income tax context, which wouldn't necessarily be relevant in the context of a merger and looking at really fair value to the shareholders. So I think it's important to, when we see different indications of value, to understand what those were used for, what underlying assumptions were applied. Sometimes there could be inconsistencies within them, right? If we're looking at fair value, it could be appropriate for a company as a whole, but that could be an indication of value that we can consider as a starting point. But that looks at the company as a whole as a going concern. Fair market value of a minority interest in that company could very well be quite a bit different. If we're looking also at a merger between two companies and we're looking at the combined value of the company, there could be synergies that come into play that are accounted for, considered by the parties that are merging the companies together, which, especially if you're doing the transaction from a gift tax purpose after that transaction, and you're transferring from the combined company, then certainly those synergies would be incorporated in your starting point. But if you're looking at the value and the merger has been agreed to, but has not yet been agreed to, or there's not yet been approved, if there is a Hart-Scott-Rodino filing in place where there is some scrutiny being applied to that transaction such that it might not close, um, there could be some uncertainty there. There could be, if there's more value for the combined company and there's some strategic value incorporated, we would need to incorporate or consider that uncertainty in valuing the shares. We see that quite frequently in the context of pre-deal planning. If there is a sale of a company and that sale is to a strategic buyer, and there's some planning that's being done in advance of that sale being completed, um, we're going to look at that transaction and say, well, that if that transaction closes, here's the value you're getting, which could be cash. It could also include other forms of consideration. But if it doesn't close, that's a strategic sale to one buyer. That is not necessarily the fair market value of the company or an interest there in the scenario in which the deal doesn't close. So we'll do a deal, no deal analysis in which we look at both outcomes, right? So those are different indications of value. We'll give them weight.
That's in a lot of contexts. We have clients, and I know I'm sure everyone on the call has had this many times. Clients often wait to well past when they should have to try to make a transfer for estate planning purposes because they kind of don't want to do it unless they think they got a real deal. But once you have a real deal, then you're getting a different valuation. Um, so we've had you guys, um, not infrequently, unfortunately, do what you call the deal no deal analysis and look at possible deals, possible no deals, and weigh all those. And I think that's incredibly valuable because when you sit down on an audit and it's a year or so later and there's actually been a transaction, the fact that you have analyzed the possibilities of that transaction a year earlier is hugely helpful. It's not been ignored, it's been evaluated. Any
Right.
thoughts or comments on that? Because I'm sure that's something everyone deals with.
In those contexts, we do, we get a couple of different uh, feedback sometimes when we're doing that analysis. One is that the deal is speculative, right? It's not going to it's a low probability event. It shouldn't be given consideration. And so what we find is when there is upside, but it's seen as low probability, we think it's ideal to at least consider that possibility because if it happens and that upside is realized, that probability of it happening was incorporated in the valuation itself, and it makes the valuation much more defensible. If we were giving it zero probability and it happens, the IRS could clearly have some very legitimate questions about the valuation result. The other scenario is where the deal is on the table and the client expects it to close, and they say, well, isn't that just the value? Well, it is the value if you think the deal is certain to close, but adjusting for present value factors, closing costs, and whatnot. But if there is any uncertainty to the deal closing, we want to at least consider that it might not close, and that's important, especially if it's a charitable donation. It's important for the valuation to address potential uncertainty in the deal closing, because if you have a low basis in the shares and they're being donated, there can be an argument for assignment of income if the deal was certain to close. So having the valuation be internally consistent with a view that the deal closing was not certain and providing support for that, providing support for where was the deal in the diligence process, how many buyers, potential buyers were there any backup buyers, providing support for that uncertainty is critical in that kind of assignment of income argument that it really wasn't a done deal at that point.
I think there's such a huge world of difference between a report not addressing it, meaning it was ignored, versus you addressing it and taking whatever reasonable position you felt as to what it meant at that time. Because without that, what do you have to negate the IRS's argument that, look, it closed? But no, we evaluated it, and here's the analysis that we did. So really important to do. And I'm assuming that estate planners whatever discipline, give you full disclosure. I'm not sure clients always give us as estate planners full disclosure, but that's certainly something that I think can make it safer. Let's change gears because you had mentioned when we were preparing another topic that I think is really important and it gets to the not just the collaboration. I think you used the word the almost iterative process of how the relationship with the appraiser and the estate planning team goes. So if we create a plan, you need to see and should see the governing document. So if there's an operating agreement for an LLC that a slice of which is being transferred in a note sale or a gift or some other type of transaction, why don't you talk about the importance of your team reviewing the governing documents that we lawyers prepare for valuation considerations?
Absolutely. So, any review that we're doing of the governing documents, LLC agreement, buy-sell agreement, or other is, at the end of the day, these agreements are going to serve multiple purposes, right? There's going to be a business purpose. There's going to be other objectives that the client and the company will have that are going to need to be addressed in the agreement, which legal counsel is going to take into consideration as part of the drafting process, right? So it's not just about the valuation at the end of the day. But what we can do is at least take a look at the agreement and flag anything that seems ambiguous or is inconsistent with what the intended result might be. There can be, for example, control provisions that might be in place. If there are certain control provisions that might, in theory, reduce the discount, we can have that conversation, and that might be consistent with the intent, right? There could be a desire for the recipient to retain a level of influence or level of control. That would reduce the discount, but we'll at least bring that to the attention of all the parties if that really was the intent, and also talk about what sort of thresholds, percentage interest might change kind of what level of control the interest transferred would have. There could also be liquidity provisions or redemption provisions that might be in place. Again, if you have, say, a corporation where there is no agreement and you have a transfer of minority interest of a closely held company, that's going to be inherently illiquid. We would apply discounts, notwithstanding that there is no agreement in place, simply because of state law and because of the liquidity of the interest and of the company. But in the event that there is a buy-sell agreement or a LLC agreement that provides certain redemption rights that are at a level of value other than fair market value. For example, it provides that, say, there's a real estate LLC, and it provides that any member can redeem their interest and receive their pro rata share of what would have been received if the real estate were to be sold and the proceeds liquidated. That might not be consistent with the intent of the transfer, because that would, of course, provide a liquidity right to an owner of the interest, which would reduce the marketability discount. So we would want to have a conversation of, is that really the intent? We have seen situations where that is the intent, right? You might have a marketable securities partnership or an investment partnership where there is the ability to redeem capital, maybe 10% of capital every 6 months or something like that. And that's the intent. There's the intent to provide some limited liquidity to the owner of the interest. So we'll bring that up. We'll say, okay, that might reduce the discount. It would reduce the discount by a certain amount. But if that's consistent with the plan, that's fine. We'll just appraise the interest with that in place. So it can be a conversation to make sure that the client and their advisors are informed about the valuation implications of certain provisions that are in the agreement, and to make sure that they're fine with that and they weigh that relative to other goals that they might have. We also, and this is another critical item I want to bring up, ambiguity of standard of value. So if there is any sort of redemption right, right of first refusal, or anything that provides for a valuation to be prepared in the context of an LLC agreement or buy-sell agreement, that standard of value should be very clear. Fair market value is very common. If fair value is used, that should be tied to an explicit state law, or have a procedure, indicated in the agreement for how that would be done. But if there is any ambiguity, if it just says the value of the interest or some other term that isn't tied to a definition or case law or anything like that, that can create some risk. And we as appraisers, we have been asked to appraise interest as a result of these provisions in the agreements being triggered. And sometimes these ambiguous terms can create some issues. And so we'll want to flag those right at the outset to make sure that all the parties are aware that there's more clarity in how the standard of value is addressed in the agreement.
No, it sounds very important, and I encourage everyone when they're doing a transaction, get draft documents. We always send you draft documents. We don't wait for the final version. If anything substantive changes, we will resend it. But it's always good to get somebody with a different eye, a different lens looking at something, because they may just see something from their lens as an appraiser that we're not seeing or not focused on. And the sooner that you can address that, and ideally before the document's signed, the better. Let me ask you a question, changing gears completely. And we didn't talk about this ahead of time, so forgive me if I'm putting you on the spot and you can just duck if you want. But a lot of times we see clients that have a business that's grown tremendously in value, and they have the same accountant that they had working out of, a basement, apartment that they've been with for the last 30 years. And the quality of the statements and the caliber of the statements is just not up to snuff. What about, I know before a client may do a deal and sell a business, it's often advisable to get a bigger accounting firm in to do an audit or to, get the books cleaned up, if you will, before. Is there anything comparable from an appraisal perspective where it can be advantageous for you to confer with the accountant who's doing the books and records, or is that not an issue with you that it is with, an investment banker, for example?
Right. So if there's a business that there is no intention of selling, right? I mean, if there is a plan to eventually market the business for sale, maybe it's a number of years down the road. I mean, that ideally that process will start earlier, right? Because anything that needs to be addressed in the financial statements, quality of earnings, anything can be addressed early, well in advance of when the business is being marketed for sale. But if there is no intention of selling the business, and the client doesn't, have a line of credit, or they're not looking to get additional financing, and there's really no need to have an audit, then that can definitely create some complications. We would probably have more conversations with the accountants in that context to understand, okay, here's the internal financial statements. On what basis were these prepared? Are these prepared under GAAP, or are these more just tax return basis financial statements? If they are tax return financial statements, we might need to have a little bit of a conversation to understand what are the key differences for what was reported versus how an investor might view the company, and how creating comparability to publicly traded companies. So for example, there could be situations where if the financial statements are on a tax reporting basis, there can be more of an acceleration of recognition of expenses and other factors, where the margins and earnings levels might not be as readily comparable to the guideline public companies. So there might need to be some conversations to fully understand what sort of adjustments the accountant would recommend be made to make those fully comparable.
So Nathan, I think we've covered pretty much everything that we had chatted about. And I told you in the beginning before we started, I was going to leave you with one final question. So here's your opportunity to tell all those estate planning attorneys and accountants and wealth advisors what they do that makes your life difficult, and how can we collaborate better so that we get a better result for our clients. You can just don't use my name in vain, but you can tell us all the evil things that we do or the bad things we do that we should improve upon.
Well, obviously, Marty, all the attorneys we work with are great to work with, and yeah, and delighted to work with them. I think what I would say is just we understand from that, again, to get to your point from the beginning, right? That these are going to be very unique situations for the clients, and whether it's an estate, which can create a lot of complications, a lot of data gathering, a lot of challenges for the client in terms of what they need to do, or if it's for a planning process that the attorney thinks is just ideal for the client, but the client is just dragging their feet on it. We're happy to be a part of that conversation, and I would say just to have the conversation up front when there is a project in place, to understand the timeline, right, of when the transaction is targeted for, to understand expectations, for information gathering, what can be done to make the client's life easier, and just to bring us on board early in the process so that we can we can help in making the process as smooth as possible for the client and help in communicating values as well. The client has an idea what their business is worth, how that's going to be different, and then if you're have a, holding the business for the long term versus a potential sale down the road that might be uncertain. So I think just having that conversation at the front end, understanding the expectations of counsel in terms of what plan they have designed for the client, and understanding what the client is trying to accomplish. If we're informed about that from the outside, we can help make the process much more smooth as we proceed.
So, any last words you wanna say?
Um, I think no. I think this has been a great discussion. And I will say, we always we're always happy. We undertake a lot of very exciting, fascinating engagements. I think we always find it to be a privilege to work, with very smart legal counsel and with their clients who have oftentimes built up tremendous businesses, which have fascinating history, a great growth trajectory, and we feel excited to be a part of that process, and basically bring our knowledge and experience to the table to help out.
So I want to thank you, Nathan Gallagher from Stout, and thank everybody for joining us. This is just part of a series, informal, not technical, just talking about what I think we all think and believe is critical to almost every estate plan: collaboration. And hopefully this has given you a few practical insights. And thank you for joining us. Nathan, thank you. Take care, everybody.